It's been nearly 2 decades since the world watched the global financial system teeter on the edge of total collapse. In 2008, the culprit was housing. Today, in January 2026, the markets are hitting record highs, fueled by an AI revolution and unprecedented government spending. But behind the green charts, a familiar anxiety is returning. Economists are pointing to the highest market concentration in a century, a $37 trillion mountain of U.S. debt, and an opaque private credit market that looks a lot like the shadow banking of the subprime era. Are we just bracing for the inevitable? Today, we're breaking down why 2008 happened, why 2026 feels so similar and yet so different, and exactly how you should be preparing for the next potential Black Swan event. To understand where we're going, we have to look at how we got here before. The 2008 crash wasn't an accident, it was an architecture. After the dot-com bubble burst in 2000, the Fed dropped rates to 1%, flooding the world with cheap money. Lenders stopped caring if you could pay back a loan. They moved to an originate-to-distribute model. They'd sign you up for a subprime mortgage, bundle it with thousands of others into a mortgage-backed security, and sell it to someone else. By the time the housing bubble peaked in 2006, the system was a house of cards. When the Fed started raising rates to 5.25%, the teaser rates on those mortgages reset. Defaults spiked, the value of those securities vanished, and the shadow banking system, the non-bank lenders who held the risk, froze. When Lehman Brothers fell in September 2008, the world realized that everyone was connected to the same bad debt. So, why are we bracing today? In 2026, the risk has migrated. We aren't worried about houses, we're worried about the AI super cycle and the shadows of private credit. First, look at the concentration. Just 7 companies now account for 36% of the S&P 500. We haven't seen this level of winner-takes-all market since 1927. If the massive $1.4 trillion investment in AI infrastructure doesn't start showing real-world productivity gains soon, we could see a tech revaluation that drags the entire global market down with it. Then there's the sovereign debt. In 2008, the U.S. government had the fiscal space to bail out the banks. Today, after the One Big Beautiful Bill Act of 2025, U.S. debt is at 120% of GDP. We are spending 19% of the federal budget just on interest. We are in a fiscal crossroads where the government might not have the bullets left to fight a new recession. And finally, keep an eye on private credit. It's a $1.7 trillion industry that operates in the dark. Much like subprime mortgages, these are loans to companies that can't get bank funding. If these companies start defaulting as rates stay sticky, the contagion could spread faster than we think. The best time to prepare for a flood is when the ground is dry. Whether a crash happens tomorrow or in 2 years, here is how you build a resilience-first strategy for 2026. Step 1, liquidity is king. Avoid forced selling. If the market drops 30%, you don't want to be the person selling at the bottom because you can't pay your rent. Keep 3 to 6 months of expenses in high-yield accounts. Step 2, the debt avalanche. With interest rates staying elevated, variable rate debt is your biggest enemy. Prioritize killing high-interest credit card balances now. Step 3, the debasement trade. Many institutional investors are looking at gold and Bitcoin. With $340 trillion in global debt, people are hedging against the debasement of paper currency. Some analysts see gold hitting $5,000 as a result of this sovereign risk. Step 4, check your concentration. If your portfolio is 90% US tech, you are effectively betting on the AI bubble. Look at international diversification or high-quality value stocks that aren't tied to the AI hype cycle. The physics of liquidity are unforgiving. In 2008, the world learned that lesson the hard way. In 2026, we have a more resilient banking system, but a much more fragile government and a highly leveraged tech sector. Don't panic, prepare. The goal isn't to predict the exact day of the crash, but to be the person who is standing when the dust settles. What's your move? Are you hedging with gold or doubling down on tech? Let me know in the comments. Don't forget to like and subscribe for more deep dives into the macroeconomic landscape. I'll see you in the next one.